Thanks, Phil, and good afternoon, everybody. Well, I don't need to now convince you that iron ore and steel is part of the transition for renewable energy. Coronado's done that for me, so thank you very much. Red Hawk Mining, we are looking to develop one of the largest iron ore projects in Western Australia owned by a junior ASX-listed company. What you can see here in the picture is a drone image of our project. It stretches over some 25 kilometres wide and about 10 kilometres from north-south. It's a project which has been extensively drilled over the last decade, and as a result we have over 200,000 metres of drilling into our deposits, which is really the start or the basis by which we're now moving forward to develop what will be a significant iron ore producer outside of the major iron ore companies. Corporate snapshot, the company's got a market capitalisation of around $100 million. We finished the quarter with $3 million in the bank, and we're currently undertaking a rights issue, which I'll touch on the next slide. You can see on the bottom corner we've got two major shareholders. TIO NZ is Todd Corporation out of New Zealand, which is a large private family business in New Zealand that owns roughly 60% of the company. And then we have a private investor, Australian-based investor, OCJ Investments, with 20%. Between them, 80% of the company is held, and they have undertaken to take up their 80% pro rata entitlement in our rights issue. So we're quite fortunate in that we started the capital raising with 80% taken up. Our share price has reached a high recently of 80 cents, and we're now trading back at around 60 cents. The board contains representatives, independent directors, but also we have two representatives from Todd on our board, being Rob Foster and Michael Wally, and Amy Zhang represents OCJ Investments. And over the last 6 months, we've built up our management team quite significantly to enable us to move from the pre-production phase right the way into production, and you can see there just a small snapshot of our senior management team. We've taken people from not only the major iron ore companies, but also people with significant experience with dealing with traditional owners and other stakeholders, which are very important when dealing in the Pilbara region. The rights issue that I mentioned, we're looking to raise $6.3 million, and of that 80% has already been underwritten or subscribed for by our two major shareholders. Because of the shareholder structure, we wanted to encourage the minority shareholders to participate. Hence, we have priced the rights issue at a 25% discount to the market price to encourage the existing minority shareholders to participate as well. The rights issue closes next week. So we're located in Elephant Country. This is the Pilbara. What you can see on the map are a whole host of iron ore mines owned by the major iron ore producers and a spaghetti junction of railway lines leading to privately owned ports. What we're looking to do is keep the project simple. We're looking to develop a trucking operation that will see us take ore from our project out to the east, joining the Manuara Red Dog Highway, which is currently being developed by Main Roads Western Australia, and then we will export our iron ore out of the port of Utah Point, which is a common user bulk loading facility at Port Hedland. So zooming in on our project, as I said, this project's had over 200,000 metres of drilling put into it. And what we've been doing over the last 6 months is identifying areas within the ore body where we can see high-grade direct shipping ore resources to be developed with a certain set of criteria. The first is that we want to be mining all of our ore above the water table. The reason for that is when we've had consultations with the traditional owners in the area, one of the biggest impacts from the iron ore mines in the Pilbara has been a progressive lowering of the water table as mines get dewatered, and that has significant environmental impacts to watering holes and other areas where the traditional owners rely on these water sources. So we've made a commitment to our local traditional owners that we will be mining above the water table. So the resources which we've highlighted here in red and blue all sit above the water table. Secondly, we're keeping the pits to a strip ratio of 1.2 to 1 or less. So low strip ratio above the water table and to a maximum depth of about 50 metres. So very simple mining. The second part of our constraint is we want to produce a 60% material, which is direct shipping ore, and so all of our resources meet the criteria of 60% iron plus low silica and alumina for direct shipping. This is a classic cross-section through a couple of our ore bodies. What you can see there in the red and the brown are the two high-grade members of our ore body, and what we'll essentially be doing is mining the red and the brown and leaving all the other material behind, either as waste from the pits or just leaving them in situ. And it's quite a departure from the previous development plans, which essentially took out all of the layer cake and then put it through quite a big beneficiation plant. We're not going to be doing any upgrading of the ore, so our processing is a simple 3-stage crushing and screening to take big rocks and produce them down into small, fines material, but there's going to be no wet processing or upgrading of the ore, which is why mining at the 60% head grade is so important, and that's where the detailed drilling that we've done over the last decade fits into that strategy. So what we've come out with in the last couple of months are 2 stages of resources. We've now got nearly 175 million tonnes of resources at 60% iron with marketable levels of phosphorus, silica, alumina, and a loss in ignition, which is acceptable to the steel mills. In a moment, I'll touch on a slide that compares us to our ASX-listed junior peer group. And what you can see on this slide is we are the big bubble out to the right with 174 million tonnes at 60%. When you look at the contained iron in our resource, it's the same as all of the other ASX-listed juniors put together. And that puts us in quite a prime position when it comes to discussions with infrastructure providers, with trucking companies, port providers and other third-party infrastructure providers. We can talk to them about having a 20-year mine life of high-grade material, where a lot of our others, ASX juniors, they have 2-3 year mine lives and producing 1 or 2 million tonnes. We have the ability to start reasonably small, and our scoping study was based on a 3 million tonne annual production capacity. But if export infrastructure opens up for us, we could increase our mine from 3 to 5 to 7 to even to 10 million tonnes and still have that 15 plus year mine life because of the size of our resource. At the end of September, we announced the results of a scoping study. These are some of the highlights. It's worth noting that the scoping study was undertaken using an $89 US long-term iron ore price. That was based on Platts, who are one of the commodity forecasters. That was their long-term price assumption. And on using that $89 long-term iron ore price, we ended up with a pre-tax NPV on the project of just over $350 million. Today's iron ore price is $130 US dollars, and adjusting for grade, we would see that NPV go up to over $1.5 billion, and our annual free cash flow in the order of $270 to $300 million per annum in free cash flow, and therefore our capital payback would be less than 1 year at current prices. BHP, Rio and FMG in their full year results presentations recently all spoke about medium-term iron ore prices in the $100 to $110 a tonne range, again significantly higher than what we've completed our scoping study at. So a very simple snapshot of the project. Again, we're trying to keep this a very simple operation. Bulk commodities should be simple. It's about moving a lot of dirt efficiently and taking product from the mine and getting it to a customer, typically in Southeast Asia. The red blobs are our pits, starting with the yellow blob, which is our starter pit in Delta. That starter pit outcrops, we're literally tripping over the Kanga ore at surface, so there's no pre-strip. Our total capital for pre-production mining is about $2.5 million, so there's very little capital required from a mining perspective to get into first ore. We've got a centralised processing plant, as I said, a very straightforward 3-stage crushing and grinding, all dry processing, and we'll be mining a series of pits from Delta and Paragon, and you can see the grey are the waste dumps. A very compact operation, and what that will be producing is 3 million tonnes per annum at 60.5% iron for 20 years, something which I don't think any other junior company in Australia can claim. From there, it's how we take it from site to a customer, and again, it's trying to keep life simple. We'll be using ultra quads, which are these 4-trailer trucks. They're 60 metres long. They've got a payload of 150 tonnes, and we will build a 25-kilometre haul road from our site out to what's known as the Manuara Red Dog Highway, which is essentially Rio Tinto's rail access road, which is progressively being upgraded by Main Roads into a blacktop dual lane highway. Highway's probably a bit of a stretch, but that's what it's called. We will then, using the ultra quads, we'll drive from site up to Karratha, turn right and take our ore out of Port Hedland. Total trucking distance is about 450 kilometres, which when you compare that to some of the iron ore producers in the midwest of Western Australia going out through Geraldton, their trucking distances are often 500 to 800 kilometres. So it's a long haul, but definitely doable with the size of trucks that we'll be doing. One of the benefits of truck haulage versus building your own rail and port is that we have flexibility. And if an alternate port was developed over the next 3 to 5 years, potentially between, say, Dampier and Onslow, which is on the west coast, we'd be able to drive to Karratha and turn left rather than turning right and go out through another port. Similarly, we can go south and then west, potentially out through the port of Onslow. So while Port Hedland is our first port because it is up and running and it's a multi-user port, we do have the ability over our 20-year mine life to go out through different ports that may give us both a combination of higher volumes but also lower trucking costs because of the shorter distance. So a snapshot of both capital and OPEX. You can see that our capital cost to first production is 150 million Australian dollars. These numbers are about a month and a half old, so they're very fresh, but included in our capital is already a 30 to 35% contingency. So once you strip that contingency back, we're at about $115 million. Most of that money is being spent on a crushing plant, on a road, the haul road, and the non-process infrastructure is mainly the camp. Things like the camp and the crusher, we may outsource to a third party who will build, own and operate those bits of kit, and that will go off our balance sheet as well. In terms of our C1 cash costs, so cash costs for ore delivered onto a ship in Port Hedland, it's roughly $50 a tonne. And as I said, today's price for the material is around $125 to $130 a tonne. So in today's market, very good margins, but even if prices pulled back to longer term $100 to $110 a tonne, we would still be making very considerable margins on our volume and with the potential to increase that volume if capacity became available. So what the financial model in our scoping study showed us was that we've got a 3-year payback on capital. You can see the red line goes back to cumulative zero after 3 years. Again, at today's prices, that would be less than a year. And where that cost structure puts us is essentially the 50th percentile for global iron ore mines, excluding the 5 majors. And I think it's important to note that for the BHPs, Rios and Vales of this world, they are fully integrated mine, rail, port facilities, and no junior company is ever going to compete with that. But in terms of the rest of the world, we're sitting at that 50 percentile, and the aim going through our feasibility studies is to try to optimise our transport and logistics corridor, which make up about 2/3 of our total operating cost. And if we can shave a few dollars off our logistics, which we're working with a few providers to better utilise truck utilisation, drivers, etc., we think we can take a couple of dollars out of that operating cost and go further down the curve as well. So going forward, we completed the scoping study in September. We've rolled straight into a pre-feasibility study. The benefit of the drilling, the historical drilling on this project, is normally companies finish a scoping study and then spend the next year or two drilling out the ore body further. 95% of our ore body is already in the indicated category, so we don't need to do any more exploration drilling. We are doing some drilling to obtain metallurgical samples from the 2 types of ore that we'll be producing, but apart from that, we will be moving straight, or we are already moved into a pre-feasibility study, which should be completed in first quarter next year, which then gets us to a definitive feasibility study late next year. And the plan for us is to be first production by mid-2025. and that'll enable us to get there. We'll need to have final investment decision late 2024, and then there's about a 12-month lead time for development towards first production. So a very short time frame from here into production, and as I said, by mid-2025 we should be producing at a startup rate of just over 1 million tonnes a year, and then ramping up very quickly to the 3 million tonne mark over the course of a couple of years. So thank you very much for your attention.